The third one, variation in reserve ratio. Under variation in reserve ratio, the RBI will make changes in the reserve ratio in order to control the money supply in the economy. Under this method, there are two concepts are there, that is cash reserve ratio and statutory liquidity ratio. So the first one is cash reserve ratio, as familiarly known as CRR. So CRR or cash reserve ratio means the minimum amount of cash that the commercial banks have to maintain with RBI in the form of deposits. As you all know that every commercial bank has to keep certain amount of cash from their total form, from the total deposits and with the RBI, and it also keeps certain amount of non-cash assets in the RBI for future use or for facing the future emergency of shortage of funds. These amount can be utilized. So every commercial bank has to keep reserve CRR as well as SLR with the RBI to meet the unforeseen emergencies in the future. So cash reserve ratio is the minimum amount of cash that the commercial bank have to maintain with the RBI in the form of deposits, whereas SLR, statutory liquidity ratio, is the minimum percentage of non-cash assets that the commercial bank have to keep with the RBI. It may be in the form of gold or it may be in the form of bonds, etc. So every commercial bank has to keep reserve the cash and non-cash assets with the RBI. Okay, so by increasing or decreasing CRR and SLR, the RBI is able to control the credit creation of the commercial bank, at the same time control the money supply of the commercial bank. Higher money supply in the economy, in order to reduce the credit creation of the commercial bank, it will increase the CRR and SLR rates. So more amount of cash and more amount of non-cash amount will be kept reserve in the RBI, and with less amount of cash and non-cash assets, the commercial bank may not create much credit in the economy. So the supply of the money can be reduced during the time of inflation, and during the time of depression, in order to increase the supply of money in the economy, the credit creation should be encouraged to the commercial bank. So RBI should encourage the credit creation of commercial bank. For that purpose, it is going to reduce the CRR as well as SLR rates. So the commercial bank will have more amount of cash and non-cash assets in its hand, so it can provide more amount of cash, more amount of loan facilities to the borrowers. So when the customers and borrowers will get more amount of loan, then the supply of money can be increased in the economy during the time of deflation as well as depression. As you all know, during the time of inflation, money supply is more, whereas during the time of depression, the money supply is less in the economy. So this should be controlled by the RBI. In order to control the money supply in the economy, the RBI is following these methods in order to control the quantity of the money or the amount or volume of credit creation of the commercial bank. By following these three important quantitative methods, that is bank rate policy, open market operation, and variation in reserve ratio. Next, the qualitative methods of credit control. The second one is qualitative methods of credit control. Under qualitative methods of credit control, the first one, fixing the margin requirements. So RBI will fix the margin. So change in margin implies a change in loan size. So by changing the margin means changing the loan size. So fixing margin means fixing the size of the loan. This method is used to encourage credit supply for the needy sector and discourage it for non-necessary sectors. So this method is given encouragement of credit supply for the needy sector and it discourages non-needy sectors credit credit facilities. This can be done by increasing margin for non-necessary sectors and by reducing it for the needy sectors. Non-necessary sectors loans should be given less importance wherever non-necessary sectors or non-priority sectors the commercial banks are ready to give loan, that loan should be taken back and that amount can be utilized for the priority sectors or necessary sectors. So loan should be given to the necessary sectors or priority sectors rather than non-priority sectors. For example, if it is a personal loan is considered as non-priority sector, importance should be given to the crop loan or agriculture loan. RBI feels that more credit supply should be allotted to agricultural sector then it will reduce the margin of non-priority sector. Other sectors margin will be reduced and more importance should be given to the agricultural sector. So agricultural sector 85 to 90% of the loan will be given to the agricultural sector and remaining that is 10% will be kept reserved for the non-priority sector. So by fixing the margin requirements, the RBI can control the credit creation of commercial bank. Second one, consumer credit regulations. Consumer credit regulations means under this method, the down payment, installment amount, the loan duration, etc. will be fixed in advance. In advance only, the commercial bank will inform you that what is the amount of down payment, what is the installment amount, what will be the term of the loan, that all will be decided in advance. After that, the loan will be provided. So it can be helpful in checking the inflation in a country. So whenever inflation is there in the economy, that time the credit amount will be reduced and short-term credits will be given to the uh, priority sectors. In that also the installment amount, down payment amount, then duration, everything will be fixed. During the time of inflation, the credit will be always short term, whereas during the time of depression and deflation period, the credit will be long term credit facilities will be provided for the reconstruction of the or for the recovering of the economy. Third one, publicity. Through publicity also, RBI can control the credit creation of the commercial bank. Central bank publishes various aspects of or various reports, weekly and monthly bulletins. So in monthly and weekly bulletins, the RBI will send the information to the public regarding the monetary policy of the RBI, regarding the situation prevailing in the economy and how much the customers can borrow and how much they cannot borrow, that every details they will get in the bulletins. This bulletins will helpful to the commercial bank in the creation of the credits to the public, and it will supply credit more to the desired sector rather than the non-desired sector. So publicity will be made by the RBI regarding the good and bad aspects in the system. Fourth one, credit rationing. Credit rationing means the RBI will fix the credit amount to be granted. So RBI will fix the amount of credit to be granted to the particular commercial bank to the particular sector. Here the upper limit of the credit can be fixed by the RBI and information will be sent to the commercial bank, and based on that the commercial bank will provide credit facilities to the customers, and more priority, upper limit will be given to the priority sector and lower limit will be fixed for the non-priority sector. So it will help to reduce the credit exposures to the unwanted sector. Unwanted sector, movement of funds from unwanted sector will be made for the movement of desired sector. For desired sector, funds should move rather than the unwanted sector or undesired sectors. Fifth one, moral caution. It is a suggestion to the banks. Moral caution is a suggestion to the banks given by RBI regarding the creation of the credit. The commercial banks are informed about the expectation of the central bank through monetary policy. The central bank can issue guidelines, suggestions for the commercial bank regarding reducing the credit supply for speculative purpose. That means RBI will give some directions, guidelines and suggestions for the commercial bank regarding the credit supply reduction for speculative purpose. For speculative purpose, the credit supply of the commercial bank should be reduced. How it will be reduced, when it should reduce, that will be mentioned in the guidelines. Sixth one, control through directives. Under this method, the central bank issues directives to the commercial bank. These directives guides the commercial bank in framing their lending policy. So directives will be sent by the RBI to the commercial bank, and whatever the directive is received by the commercial bank will follow these directives as a guidelines while making their lending policy. And RBI always issues directives to the commercial bank for not lending loans to the speculative sector beyond a certain limit. Beyond a certain limit, if the loans are lent to the speculative sector, in that time the RBI has the authority to question the commercial bank regarding the provision of loan. Seventh one, direct action. Direct action means RBI directly impose an action to the commercial bank. This direct action will be taken to only those banks which does not follow the rules and regulation or changes made in the monetary policy of the RBI. Whatever the changes made by the RBI which may not be followed by certain banks, in such banks the RBI will issue a direct action, and RBI also can penalize the commercial bank for changing the rates in loan as well as interest. So all these are the qualitative methods of credit control. Under this qualitative methods, RBI will reduce the movement of funds to unwanted sectors than the desired sectors. Funds should move to the priority sector rather than the non-priority sectors. All these are the various methods used under qualitative methods of credit control. It reduces the movement of fund from non-priority sector to priority sectors.